Weaker than expected GDP delivering the latest blow to the U.S. currency. The report setting the dollar to a what is that? 3-year low, more than 3-year low, 3.5-year low, really. So what does this all mean for the supposed goal of getting to consistent 3% GDP every quarter? Matt Bozer, our U.S. economy reporter, is here with some charts. So walk us through what you've dug out.
Yeah, so GDP missed estimates today, as you noted, but it was really due to some of the noisier components that swing around a lot, like trade and inventories. So when you really drill down to kind of like the underlying fundamental trends in the U.S. economy, the report was actually quite good. So these two lines kind of show those two key indicators that we watch. The amber line is the contribution to real GDP growth from consumer spending, and you can see that's really been steady for a few years now. Now, the blue line is the contribution from business investment, and that dipped quite a bit in 2015 and 2016 when we had the oil crash, and of course the surge in the dollar that hurt not only oil industry but U.S. manufacturers more broadly. And you can see over last year that's really rebounded quite a bit, and we're kind of back up to those levels where we were before. So that's a really good sign, and it kind of calls into question, what's the outlook for business investment now going forward.
But it looks like balanced growth, that we're not too much relying on any one leg of the stool, and that it's well-rounded.
Yeah, that's exactly right. So that was the big concern, of course, 2 years ago when investment fell off a cliff. Normally, you don't see that outside of recessions, but the consumer was able to keep things going.
All right, so let's dig into business spending, because a lot of that is capital expenditures, investing in equipment.
Yeah, so that's really kind of like the key question for the outlook going forward, with all of this stuff we have going on in Congress, with the tax cuts, and then, of course, with the tighter labor markets. Are we going to see this pick up in investment? So if you look at this chart, this is the three main components of business investment. The blue line shows equipment investment, and you can see that's really where a lot of the rebound has come from. The amber line is structures, so those are your buildings, hasn't picked up quite as much, and the red line is intellectual property, so things like software, that sort of thing, which has been more steady. So the equipment investment is really what has kind of rebounded, and the question then becomes how much of this is just due to sort of payback from the slide that we had in 2015 to 2016 versus what is sort of a new trend here, potentially taking us higher going forward. And the other thing to note from this chart is that equipment investment is really the one where it seems like there would be upside based on how high it's been in previous expansions, whereas the other two are kind of where you would expect them to be.
Which one would get the biggest boost because of the tax change?
That's a great question. So I don't think we really, have that well thought out at this point. I think you could make different cases for all of them. It kind of depends on which industry you're focused on. Probably you would expect to see it more in equipment and IP as opposed to structures.
And speaking of which industry, it's really interesting when you look beneath the hood of the equipment, where the investment is specifically with equipment here, because the biggest increase now, or the most investment, looks to be medical equipment.
Yeah, so this is the most interesting part to me, because if you look at that equipment investment number, there's all sorts of things from computers to trucks that go into that, right?
And that's the red line that we're looking at here. Blue, communications equipment, yellow is computers.
Exactly, and so there's this thing called, information processing equipment that was really the key driver of this boost of investment in this report. But the interesting thing is, that information processing equipment category includes medical equipment, which I think is something that a lot of people don't necessarily realize. You think of that as computers, and you can see that, in this latest report. So investment in computers has picked up quite a bit, but that also fell in 2015 and 2016 when we had all of that sort of trouble in the oil patch and in the manufacturing industry. So it's not clear how much of that is just a rebound. Where you really see this new higher trend is in medical equipment investment, and that is now driving overall investment in information processing equipment. And so if anything, this kind of seems like maybe something to watch in terms of, what we can expect to see higher investment from going forward.
And that maybe also speaks to one of the areas of where we are seeing inflation is in health costs, which continue, right, to see increases. So
with
maybe
rising premiums,
that's a reflection of that.
Yeah, it really
aging
speaks,
population, et cetera.
Right, and sort of the structural, shifts that are going on in the U.S. economy. It's not so much about manufacturing and oil extraction maybe as it used to be, but now we're also seeing the rise of the healthcare sector, and that's actually becoming a big driver in investment.